Joining me now to discuss emerging market currencies and emerging market equities is Marc Chandler, Global Head of Currency Strategy at Brown Brothers Harriman in New York. Marc, it's a pleasure to have you on DukascopyTV. Now, first of all, Marc, how do you think emerging market currencies have held up so far this year amid this global slowdown?
Sure, I think that the emerging markets are no longer this homogenous group of countries. There's been a great divergence. For example, this year, the strongest currency has been the Hungarian forint, which is up about 10, almost 11% against the U.S. dollar, while the weakest currency, Argentina peso, is about 8% lower against the dollar. So there's been a wide divergence, but I would think that generally speaking, the Latin American currencies outside of Brazil have done fairly well. And I would say that the Asian currencies generally firm, but not all of them. I'd say in particular the weaker ones would be Indonesia and India. China basically flat for the year, but stronger ones would be like the Singapore dollar, which is up almost 6% against the U.S. dollar, and the Philippine peso, which is up about 5%. So I'd say in general, the countries that are closer to China and affected by China and commodity slowdown has been one sort of theme. Another theme has been what equity investors have done. And foreign equity investors have poured a lot of money into India this year, even though the Indian rupee is not a particularly strong currency, down about 2.5% this year. But already this year, over $13 billion, almost $14 billion, foreigners have poured into India's equity market.
In your opinion, what are the most attractive currencies to invest in at the moment and also the least attractive?
I think it depends on what one is looking for and sort of as an investment vehicle, what's the driving force, if it's yield or if it's equity market returns. But in general, we think that the West European crisis is still going to affect Eastern and Central Europe. And so even though the Hungarian forint, as I mentioned, has been strong and the Polish zloty has been strong, we're more concerned about them. Asian currencies, we think, are weighed down by the slowdown in China. And so that really leaves us with a couple of countries in Latin America that we particularly like. Mexican peso has been strong this year, but because it's tied to North America and as a risk-on currency, tends to be highly correlated with the U.S. equity market, we tend to love the Mexican peso, be more inclined to be buying that on pullbacks.
What about growing tension between Japan and China over the ownership of islands in the East China Sea? How is this weighing on market sentiment?
The tension between China and Japan in the South China Sea, very important, but not so much for investors yet. I think that we see some, we were concerned about demonstrations and protests in both countries, and maybe some linkages for China maybe retaliate against Japan like they did in the past, maybe with rare earths. We see some Japanese companies operating in China, reducing production for a period of time. But in general, it hasn't really become a major investment issue, or I should say it's been overwhelmed by other investment considerations like the slowdown in China, Bank of Japan just having another round of quantitative easing. But I'm more concerned about this tension from a political point of view. China is in the middle of an important transition of power, and so is Japan in a way. Japan looks like they're headed for an election. And it looks to me like in Japan, the LDP, the Liberal Democratic Party, and a new party, which is nationalistic, is likely to come to power. And so I think that neither side in this dispute, China or Japan, can afford for domestic reasons to back down. So I think that tensions will be heightened. We haven't seen the end of this problem.
Well, despite recently approving massive infrastructure projects, in the eyes of many analysts and investors, China is clearly in need of more stimulus. But how much more and when?
Yeah, that's a good question. We suspect that a lot of the current stimulus that they previously announced about infrastructure, about $150 billion equivalent, we're concerned that a lot of those were already in the pipeline and were already factored into a lot of the numbers. So we still think that China hasn't really done that much yet to stimulate the economy. So we suspect more is coming. We suspect more on the fiscal side than the monetary side, partly because the housing prices, real estate prices, still seem to be higher than where officials want them. So in general, I'd say I fully agree. More stimulus needs to be coming from China, and I think we're going to likely see that in a form more fiscal than monetary. And I think that what it also means is that we shouldn't expect the currency to appreciate from here.
Emerging market equities have been out of favour with many investors for many months now, but could now be a good time to get reinvested in high-growth emerging markets?
I think that high-growth emerging markets begs the question about the decoupling. I think that what we just saw happening is that the Federal Reserve engaged in another round of quantitative easing, open-ended. BOJ did, as the Bank of Japan did, and the ECB has stepped up its efforts and made cut rates. So with the northern high-income economies under some pressure still, and weak growth should be the optimistic outlook. I'm afraid that it's hard to imagine where strength is going to come from in emerging markets, where the source of aggregate demand is, because many of these emerging market countries, as you know, are either tied to commodities or tied to exporting goods to the high-income economies. And so I think that, personally, I'm a little bit more cautious right now on emerging market equity investment. I think that we've chased those markets for many years. So I'm just not sure. I think one has to be very selective and think about what they're really buying.
What about this big round of monetary easing we've seen over the past few weeks from central banks around the world? With global growth and trade slowing, the need to boost exports and central banks around the world depressing their currencies, could we expect to hear a lot more about this currency war concept again?
I'm just not sure that quantitative easing leads to a weaker currency. I'm not sure that what's really going on here is a currency war per se. I think you want to see a currency war, I think it would require capital controls. I think leaving aside Switzerland, we're not really seeing the major industrialized countries adopt capital controls. And I think that would be a sign of a currency war. Raising tariffs on trade would be a sign of a currency war, a potential currency war. I just don't see those signs. I think of course, when a central bank is easing monetary policy, they prefer to see a weaker currency because a stronger currency at some point offsets that monetary easing. Typically, a central banker wants the currency to go in the same direction as monetary policy. And so some countries, even in the emerging market space, are cutting interest rates. We saw Turkey prepare the market for an interest rate cut. We've seen Brazil cut interest rates. And so I think that if currencies do weaken right now, I think it's a secondary byproduct of pursuit of monetary policy rather than a currency war per se.
Mark, I'm afraid that's all we have time for, but thank you very much for your comments, and again, a pleasure to have you on DukascopyTV. Now, for more exclusive interviews, financial news and Forex updates, stay tuned to DukascopyTV. But from me for the moment, goodbye.